bear with me here 1 second. Okay, so, first disclaimer. As always, read through this and pause the video and understand the risks. These are just my opinions of the marketplace. So, I want to discuss quite a few things here. One of them is going to be spreads. I noticed a lot of people have been watching my videos, and I get it. I get why you're watching it, and I can see how you're trying to figure out how to manage risk and all that. But the one thing that a lot of people, and I can tell when I talk, when people pay attention to what I watch, I can tell that there are some people that are just in it just to, just get right to the point, or they're just not like getting on that level where you can use spreads to generate income. Because a lot of you probably don't realize this, but the stuff that you use every single day of your life is actually something that you can use to generate income. It's actually publicly traded. So I really want to focus on making ends meet. So how do we make ends meet? Well, we have to make income, right? So, for example, I know a lot of you, not all of you, but some of you probably have a trash bill every month. So what I want to do is I'm going to add a symbol, and a big company out there that has, or well, not has, but does do trash pickup. And this is crazy. So like waste management. I mean, how many of you use waste management to pick up your trash? And you probably don't even realize this, but you can actually go over to Robinhood. I'll pull this up here, and if your understanding of price action is on a level such as mine, you would be surprised at how many trash bills you can pay for and how much income you can make with this. So this is an hourly chart. So I like to start with a weekly, well, monthly first, but let's go up monthly. So let's mark out our PD rates on the monthly. So this short-term high right here, right there, that's the first thing I look for, is the short-term high being taken. So that candle is lower, this candle's higher, this candle is lower. This candle came up, took it, short-term high. Now that does not mean that we're going to go higher above this high. That just means that there's a possible change in sentiment. And if you look, we also have a short-term high taken here. And this is going down to the weekly chart. So that's the first thing I see here. And then I want to take my fib. I'm going to just stick with the bodies right here. But we have a short-term shift in market structure. We have a new price leg higher. Nice energetic price run right here. Left a fair value gap. Came in here. Traded down below 50% on the fib. We can also mark our consequent encroachment levels here on our wick. So we'll take 0.5 here. Right on 1644, so we'll take the coordinates down to 4, 16144. As you can see, fib right here, that's consequent encroachment of this wick. I'm going to take this fib off, and I'm also going to do it here. I'm going to mark consequent encroachment here. So it's difficult to see that. Let me fix this here. Now I can see it. So I have that one marked, and then we have this one as well. 5923. Use that to 23, and mark that over. Draw that out in time. So ultimately speaking, we have traded into a premium here, and it's obviously it's rebalancing this, because when you get those really long wicks like that, like a really long tail, it's just like, in my opinion, it's like the super wide open like imbalance, like just comes all the way down there. So I don't have that understanding. I have noticed that there is some commentary on that, and I'm going to study that myself, so I'm not going to comment on that. I just know that that is something that does occur. So we have right here consequent encroachment, that really long wick on the weekly chart right here. CE of the wick weekly, and then consequent encroachment. Of fair value gap week. So what I mean is the weekly fair value gap. So this BISI right here. This is consequent encroachment of it. Now we're going to work out daily. We're going to notice that market is taking out a short-term high right here. And it's very, very difficult to navigate through this. Especially like if this candle right here, like this one right here, hasn't printed above this high. But when you're right here and you see it print, it takes out the short-term high. It can be very frustrating. So you have to use these higher time frame PD arrays to basically manage your stop loss. Whereas right here, we're actually getting more clues that the market wants to trade higher. So we have multiple shifts in market structure here. Right here, one. We have one right here. But the thing is did it leave a fair value gap? Yes, it did right here, but it came right back. And if you had your stop right here, you got stopped out. That's why I'm saying that this can be difficult, because it can come back and knock you out. You have to be patient, especially on the higher time frame, and let it do its work. So, in my opinion, if this were a 1 minute chart, 5 minute chart, the first thing I would look for is there like buy side liquidity. Yes, there is. These highs, they're relatively equal to each other. They're not super clean, but they are relatively equal. So if you take the wick away, you'll notice that there's lots of just stops building up. It's not really like an immediate term high here. Like there's no immediate term high. There's realistically speaking, this high is lower than this high, and this high is lower. But this high broke this high. So that tells me that the immediate term market delivery of price is shifting towards this high. So I'm not going to get into immediate term highs, but immediate term highs are basically a high with two short-term highs on both sides of it. And since we have a market that is breaking immediate term highs and basically, how do I put this? Basically long-term lows in the marketplace are forming. So what I mean by that is a long-term low is basically a low with two immediate term lows on both sides of it. So we have right here an immediate term low right here. It's not the cleanest, it's hard, you gotta zoom in to understand it, but this low right here is an immediate term low. There's a short-term low to the left and a short-term low to the right. So this is an immediate term low. On the left side of the chart, you see another, let me narrow this down. I'm going to turn the wicks back on. You really have to pay attention to this. So these lows right here, There's an immediate term low. Now we're looking for a long-term low. So a long-term low, no, not this one. Actually, yeah, this one's higher than this one. So this low has an immediate term low on the left of it. So there's a short-term low right here, short-term low right here. Yeah, this one right here, which is making this low an immediate term low. And then if you go over to the right side of the chart, choose the lowest low. So this low is a short-term low. This low is slightly lower, and this is a short-term low. So this is an immediate term low, an immediate term low over here. That makes this a long-term low. And as you can see here, we've taken just teeny little poke below these relatively equal lows right here. Super precise. Like, see how it just pokes right down there and grabs those stops? Just goes right through them, and then boom, it just takes off. This is where you're watching, because you're seeing that you got shift in market structure. Yes, when it went up here, you're not looking at this as buy-side liquidity because none of this liquidity was here and needed to form. So you're seeing just over and over again, lots of relatively equal highs, lots of resistance where retail traders would think that this is resistance and it's going to come down to support, and it does not do that. So right here, if the chart was printed right here at this low, you would be looking for a short-term high to be taken in a fair value gap. And in this case, your wonderful mentor, ICT, has taught implied fair value gaps. Sorry, I mumbled. Implied fair value gaps. So half of wicks. I'm not going to teach that in here, but if you take away the wicks, you can see how there's still that fair value gap. I think that's probably why he calls it implied. So this is fair value gap. Right here. Comes down, shift in market structure right here. Leave this gap. You're long, and you're targeting the buy side above these highs. This high, you're taking partials above this high, taking partials above this high. Every PD array that you see, you take a partial. Now, obviously, I am not involved in this asset class, but I can show you how to, with a small amount of money, how to generate income to pay your garbage bill. So waste management. Now I'm going to leave it at this, and we'll close this video out after this. So, waste management. So this is the thing, is in this sort of situation, I'm going to put the wicks back on, and I'm going to show you how I would engage this if I had like $100 or $500. Doesn't really matter. It just depends on how much your spread is. So in this situation, my particular stop, since the market has actually tipped its hand and it's leaving a fair value gap, my mouse is acting up. So, come on. Hate it when it does that. Apologize for that. Excuse me. So, in this particular situation, I prefer that my stop or my strike price, in this case, would probably be a more appropriate way to say it. 162, mean threshold of these order blocks right here. So these down close candles, I'll put it right down below here. I would stick with 162. My mouse would cooperate with me. Stupid thing. Oh, there we go. So, expiring June 23rd. So, thankfully, Waste Management actually has expiration dates every week. So, let's say your average bill is due in 30 days. All you gotta do is, in this situation, since we're expecting higher prices, we're going to sell put. This would load. I'm going to go 162. So I'll sell put, and then we're going to buy a put underneath it. I believe is the correct way to do it. Yeah. So this right here, this is your credit. $30. So you multiply that by 100, and click continue. Obviously, try to get your best possible fill. I would recommend using Thinkorswim or TD Ameritrade or whatever broker platform you choose to use. I'm not recommending it. Sorry, I did not mean to say that. I personally am of the opinion that you will get a better fill if you use Thinkorswim, and you'll actually get a fill closer to the ask. So basically what this means is, as long as by July 21st, in 30 days, as long as Waste Management stays above your strike prices, 162.50, you are good to go. You're going to keep the full credit, and you can use that to pay your garbage bill. Your max loss would be 202. So basically that's just the difference between the spread. So you open a spread for $48 of profit, you get to keep the credit, but if it goes against you, then you pretty much lose it all. And if you break even, basically your break even is 162.02. That's the minimum it can go for you to break even. And then your max loss is 202 because it basically became in the money and you want it to expire out of the money. So that's one way you can use stocks and options to pay bills, specifically garbage bills. There is other ways to make ends meet. I will talk on that in another video, but I'm just going to leave it at this, and you guys hopefully will learn something from this. As long as you pay attention, you should be good to go. But you have to understand price action first, so you can't just hop in here and be like, oh, I'm going to pay my garbage bill. This is just my opinion and something that I would do. So if you found this helpful, feel free to hit the like button below. I'm going to keep uploading more videos to help you guys pay your bills. I can't guarantee success, and I can't guarantee you that you are going to be able to do this. I'm just saying that I am here to help. So I'm going to leave it at that. You guys enjoy the rest of your day and the weekend coming up. And I will hopefully upload tomorrow or later tonight. But I don't promise that.